Welcome back to the deep dive. This is where we take those huge piles of shared research and really boil them down into the key insights you need.
That's right. And today we're looking at a company that's, well, it's fundamental to how we all get around, really. It's deep inside the aerospace supply chain.
Yeah, we've synthesized a lot of sources analyzing this company. It might not be a name everyone recognizes immediately, but its parts are flying overhead constantly.
Absolutely. So our mission today is a really thorough deep dive into Howmet Aerospace Inc. The ticker is HWM.
And we're basing this on analysis current as of October 31st, 2025. The stock closed that day at $205.95.
Okay, so Howmet. They're a critical Tier 1 supplier. Very high-tech stuff for aerospace and defense. And the sources, they really frame the discussion around a great question.
Yeah, it's the core tension here. With aircraft orders at record highs, is Howmet Aerospace basically the indispensable high-margin engine powering the skies?
Or is that premium valuation, flying a bit too close to the sun?
Exactly. So, is the performance justifying the price? That's what we're digging into. Let's get started right away with the basics of the business. Okay, Chapter 1, Business Understanding. You mentioned Tier 1 supplier. Let's clarify that for everyone listening. What does that actually mean, and why does it give them an edge?
Right, it's really crucial. Tier 1 means they sell directly to the big guys, the OEM's original equipment manufacturers. So think Boeing, Airbus, or engine makers like GE Aerospace and RTX.
Okay.
They're not selling parts to other suppliers, like a Tier 2 company would. Being Tier 1 means Howmet's components are designed into the aircraft and engines right from the start.
Ah, so they're integral from day one.
Exactly. And that gives them, well, stronger negotiating power and helps lock in these really long supply contracts, often decades long.
And you can see that connection in the revenue mix, can't you? It's heavily weighted towards aerospace and defense.
Yeah, overwhelmingly. Commercial aerospace, that's the biggest chunk at 53%. Then you had defense aerospace at 14%. So combined A&D is almost 70% of their business. They do have other segments like commercial transportation, that's mostly heavy trucking wheels, forged aluminum ones, that's about 17%. And then industrial and other is around 16%. But yeah, the core business, its health, is really tied to this massive aerospace supercycle that's happening right now.
Okay, let's break down their structure then, the four product segment, because this is where that technological advantage, the moat, really comes from. Engine products is often called the crown jewel, right? Why is that?
Well, simply put, it's the hardest part of their business for anyone else to copy, and it's the most profitable.
Okay.
This segment makes up to 90% of the structural and rotating parts inside a jet engine. We're talking turbine blades, vanes, those seamless rolled rings.
Stuff under incredible stress.
Exactly. Extreme stress, unbelievable speeds, and temperatures over 3,000 degrees Fahrenheit. I mean, these conditions would literally melt normal metals.
Wow. And that necessity leads to the second part of their advantage, the proprietary superalloys.
Precisely. Howmet isn't just selling, metal parts. They're selling the certainty that these components won't fail under those extreme conditions.
Right.
They're special superalloys, often based on nickel or titanium. They've been developed over decades. That, plus their manufacturing processes, like investment casting for complex shapes, like single crystal turbine blades. That's their core IP.
IP being intellectual property.
Yeah. And get this, their knowledge base is so deep, they've actually invented over 90% of all the aluminum alloys that have ever been used in aircraft.
90%. That's staggering. You just can't replicate that quickly.
Not overnight, not even in 10 years. Then you've got the other segments, which are also critical. Fastening system sounds kind of basic, maybe.
Nuts and bolts, yeah.
But these are highly engineered fasteners. Think things like their Flight Type brand. They're essential for holding the plane together, especially with newer composite materials. These need special protection against things like lightning strikes.
Interesting, okay. And engineered structures.
That's like the skeleton of the aircraft. Big structural parts made from titanium, nickel, aluminum, the frame, essentially.
Got it.
And finally, forged wheels. They actually invented the forged aluminum wheel back in 1948.
Wow, pioneers there too.
Yeah. This segment is facing a bit of a downturn now because the trucking market is slow, but it's still important diversification, and their wheels are known for being lighter, stronger, helping with fuel efficiency.
Okay, let's talk about competition, or maybe the lack of it. Why are the barriers to entry so incredibly high here?
Well, it's a combination, really. First, capital. You need billions, literally billions, just to build the specialized facilities, smelting, forging, advanced manufacturing.
Okay, so money is a huge hurdle.
It's huge, but it's not even the biggest one. The real killer is the certification. Every single critical component has to go through years of rigorous testing and get certified by regulators like the FAA in the US or EASA in Europe.
Years per part.
Years. A potential competitor could sink a decade and a fortune just trying to get one part certified for one type of aircraft.
That's incredible. And that leads to the real stickiness, the high switching costs, right? This is why they can command those margins.
This is the absolute bedrock of their business model. It's almost like a razor and blades model, but for, massive industrial equipment.
How so?
Once a Howmet component, say, a specific turbine blade is designed into an engine platform and it gets certified. Well, the OEM, like Boeing or GE, is essentially locked in.
Locked in for how long?
For the entire life of that aircraft program. We're talking 20, maybe 30 years. Because redesigning, retesting, recertifying with a new supplier's part, it's prohibitively expensive.
Right.
And it introduces enormous risk. Nobody wants to take that risk.
So once you're in, you're in. And that must make the aftermarket business incredibly valuable.
Oh, absolutely. The initial parts sold to the OEM for the new plane, that's called original equipment, the OE. Margins there are good, maybe 20, 30% gross margin.
Right.
But the replacement parts sold years later for maintenance, repairs, the aftermarket, spares, those can have gross margins of 60%, even 70%.
Wow. Big difference.
It's huge. So this giant backlog of new planes being ordered now, that guarantees not just the initial OE sales, but a massive high margin stream of aftermarket revenue for literally decades to come.
And the overall industry environment is playing right into their hands, too. Talk about the industry tailwinds.
Yeah, the timing is perfect for them. This aerospace supercycle is, well, it's historic. Commercial air travel demand is booming. You've got the rising global middle class wanting to fly more.
Mm-hmm.
And at the same time, airlines need to replace their older planes. They're facing pressure for better fuel efficiency, lower emissions, ESG goals.
Right. The modernization push.
Exactly. And that's created this unbelievable backlog. Orders for new planes stretch out 8.5 years right now. Howmet basically has guaranteed demand for the next decade just from that.
And defense spending helps too.
Definitely provides a solid floor. Geopolitical tensions, unfortunately, mean defense budgets are stable or growing.
Yeah.
That supports demand for parts in things like the F-35 program and also for maintaining older military aircraft.
Okay, so mostly positive tailwinds. But you mentioned one headwind earlier.
Yeah, we should be clear about that. The contrasting headwind is that cyclical downturn in their smaller forged wheel segment tied to commercial trucking. Management is open about this drag.
But it's relatively small compared to aerospace.
Exactly. The strength and sheer length of the aerospace and defense supercycle just dwarfs that issue. It's more a footnote than, a central risk to the overall story.
Okay, so the business itself, it seems built on a really solid foundation. Technology, market position, very strong. Let's look at the leadership. Moving to Chapter 2, Management Evaluation. John C. Plant, the CEO, seems key here.
Yeah, stability and, crucially, alignment. Plant is both executive chairman and CEO, and he is heavily invested personally.
Well invested.
He owns about 0.72% of the company's shares. Now, given Howmet's market cap, that stake is worth over $584 million.
Wow. Okay, that's definitely serious skin in the game.
Absolutely. When the CEO's personal fortune is tied that directly to the long-term stock price, you can be pretty confident their decisions are focused on sustainable value for all shareholders.
And his track record, especially post-2020, points to strong operational execution, right?
Oh, absolutely. It's been a real focus on efficiency. They've delivered significant margin expansion consistently. They've been very disciplined about paying down debt, and they just generate powerful free cash flow even while investing back into the business.
And the latest results, Q3 2025, they really highlight that.
Yeah, those record margins in Q3 are direct proof that the efficiency drive is working exactly as planned.
Let's dig into their capital allocation strategy. It seems very targeted.
Extremely disciplined. You can see where their priorities lie. For 2025, 70% of their planned $330 million in capital expenditures, their CapEx, is going directly into that high-growth, high-margin engine product segment.
So feeding the crown jewel.
Precisely. They know where the best returns are, where the longest contracts are, so they're putting the money where it works hardest.
And beyond investing in growth, they're also returning a lot of cash to shareholders.
Aggressively. We saw $600 million in share buybacks just year to date in 2025. That shrinks the share count, boosts earnings per share, and then they just announced a 20% increase in the quarterly dividend, up to $0.12 per share. That signals real confidence from management about future cash flows being sustainable.
That's a strong signal. And it ties in with their focus on the balance sheet, too.
Yeah, they recently paid off the last bit of a U.S. term loan, about $63 million. It's part of this ongoing push to strengthen the balance sheet, reduce debt, cut interest payments, and let more profit flow straight through.
Okay, this execution shows up clearly in a key metric, return on invested capital, ROIC. Howmet's is around 15%, maybe heading towards 17%. Why is that number so important, especially for an industrial company like this?
ROIC is maybe the ultimate measure of how well a company creates value. It shows how efficiently they use all the capital available to them, both debt and equity, to generate profit. Now, we estimate their cost of that capital, the weighted average cost of capital, or WACC, is somewhere between 8% and 10%.
Right, so the return they're generating, 15, 17%, is significantly higher than the cost of the money, 8, 10%.
Exactly. That gap, that spread, proves management isn't just spending money, they're generating real economic value. Every dollar they invest earns substantially more than it costs.
Creating that virtuous cycle you mentioned.
Precisely. Reinvesting profits at high rates of return fuels growth and compounds value for shareholders over the long term. It's what you really want to see.
One last point on management. There's a CFO change coming up.
Yes, that's worth noting. Ken Giacobbe is retiring. Patrick Winterlich is joining as the new CFO on December 1st, 2025. He comes from Hexcel, which is actually a competitor in the composites space.
So he knows the industry.
He does bring relevant experience, which is good, but, any change in a key financial leadership role like CFO is something investors should just keep an eye on during the transition.
All right, let's put some numbers on all this operational strength. Time for Chapter 3, Financial Analysis. The growth story seems to be picking up speed.
Yeah, it's not just steady, it's actually accelerating. If you look at the 5-year average revenue growth, it's a solid 8.6%. But Q3 of 2025, revenue was up 14% compared to the previous year. That's $2.09 billion. And that's a noticeable jump from the 8% growth they saw in the first half of the year.
So the supercycle tailwind is really kicking in.
It seems like it. And management is clearly feeling confident, too. They raised their full year 2025 guidance to about $8.19 billion.
Okay.
And they're already projecting 2026 revenue could hit around $9 billion. That suggests they see this 10% growth continuing.
That top-line growth is impressive. But what about profitability? The profit margins.
This is where the quality of the business really shines. Margins are high, and importantly, they're expanding. The trailing 12-month operating margin is 24.6%.
Okay.
But in Q3 alone, the operating margin hit 25.9%. That's up 300 basis points, 3 whole percentage points from the same quarter last year.
Now, given how much they have to invest, the CapEx, is that margin expansion really that impressive? Or is it just what you'd expect with their pricing power?
No, I think it's genuinely impressive, especially when you consider things like rising costs for raw materials, titanium, nickel, energy.
Right.
The fact that they can push those costs through and still expand their own margins, that speaks volumes about their competitive position and pricing power. That record-adjusted EBITDA margin of 29.4% in Q3 is really strong evidence.
Okay. Let's talk cash. Free cash flow, FCF generation. For value investors, this is often the bottom line.
Cash is king, right? Howmet generated $423 million of free cash flow just in Q3. Over the last 12 months, that's $1.28 billion.
Solid numbers. What about the quality of those earnings?
Very high quality. Management actually targets a long-term goal of converting about 90% of their net income into free cash flow.
90%.
Yeah, which is exceptional for an industrial company. It means their reported profits aren't just accounting figures. They translate almost directly into real, usable cash that the company can deploy.
Okay, let's look at overall financial stability and health. The earnings growth has been pretty dramatic.
It really has. The 5-year compound annual growth rate for earnings is almost 40%. And over the last year, it accelerated to nearly 50%.
Wow.
And this strength is reflected in other metrics too, like the Piotrowski score. Howmet scores a perfect 9 out of 9.
Can you remind us what that score measures?
Sure. It's a 9-point checklist looking at profitability, like positive cash flow, leverage, like is debt going down, and operating efficiency, are margins improving. Getting a 9 means the company passes every single test. It signals really strong financial health and prudent management.
And the balance sheet backs that up.
Completely. Debt to equity is low at 0.65. And net debt compared to their last 12 months of EBITDA is at a record low for them, just 1.1 times.
Very conservative.
Exactly what you want in a capital-intensive business that throws off a lot of cash. The credit rating agencies see it too. S&P just upgraded them to BBB plus, solid investment grade.
Liquidity looks good too.
Yeah, strong current ratio of 2.35. That means they have $2.75 in current assets for every $1 in current liabilities coming due. Plenty of cushion.
And finally, that dividend increase we mentioned. Is it safe?
Extremely safe. Even after the 20% hike, the payout ratio, the portion of earnings paid out as dividends, is only 12.36%.
Tiny.
Tiny. Leaves a massive cushion and pretty much guarantees they can keep growing that dividend, supported by all that free cash flow. Hashtag tag mid-episode break and Cal out.
Okay, let's pause there. We've painted a picture of Howmet Aerospace as, well, an objectively high-quality company. Strong tech, great market position, disciplined management, excellent financials that are even accelerating.
Yeah, the internal picture is really, really strong. No doubt about it. But as investors, we know it's not just about buying a great business. You have to buy it at a reasonable price.
Right, and price is set by the market, by external perception. So we need to shift gears now, from looking inside the company to looking at how the market views it.
Exactly. From analyzing the metal to analyzing the money, so to speak.
But before we tackle that big question, is the premium price justified? Just a quick word from our partner.
Yeah, if you appreciate this level of deep dive analysis, getting into the weeds like this, then you really should check out the Stock Analytics AI community.
Like and subscribe to the Stock Analytics AI YouTube channel.
Seriously, for just €4.99 a month, members get access to this incredible playlist, 500 deep dive videos covering all the S&P 500 stocks. It's an amazing resource.
And what's coming up next is huge too. Exclusively for members, we are covering the entire NASDAQ 100.
Plus, members can request specific stock deep dives. If there's a company you want us to break down, just drop the ticker in the comments and we'll get on it for you.
Okay, great value there. Now let's get back to Howmet and see how the market is pricing all this operational excellence. All right, let's jump into Chapter 4, Market Sentiment. And we have to start with the elephant in the room, the valuation conflict. Great company, yes, but wow, that stock price looks expensive.
It is. I mean, that's the core of the bear argument right there. The trailing 12-month price-to-earnings ratio, the PE, is hovering around 58 to 60.
58 to 60 times earnings. Let's put that in perspective. How does that compare?
Well, it's way above Howmet's own historical average PE, which was more in the range of, say, 38 to 45.
Okay.
And compared to its peers, also very high. GE Aerospace is around 41.8x earnings. RTX is about 36.3x. And if you look at a defense-focused company like Northrop Grumman, they're way down at 21x.
So a massive premium for Howmet. What does that imply?
It implies the market isn't just pricing in the current success and the existing backlog. It's pricing in years of continued, absolutely flawless execution. And not just execution, but significant growth on top of that in volume, in margins, probably over the next 2 to 3 years. The expectation bar is set incredibly high.
Okay, so very high expectations baked in. Yet, paradoxically, Wall Street consensus seems overwhelmingly positive.
It is. The consensus rating is a strong buy. Over 80% of the analysts covering the stock, and there are a lot, like 21 to 28 of them rate it either buy or strong buy.
So analysts love the company fundamentals?
They definitely agree the business is strong. But here's the disconnect. The price target disconnect. When you look at their average 12-month price target for the stock, it's actually in a pretty tight range, somewhere between $191 and $212 per share.
But the stock is already trading at $205.95.
Exactly. So the analysts are basically saying, fantastic company, top-notch execution. But from this price level, we don't see a whole lot of upside in the next year. Limited immediate gains perceived by the street.
Interesting. What about the technical picture, momentum?
Technically, the stock looks very strong. It's in a clear uptrend on, well, pretty much all time frames.
Okay.
The price is well above its 50-day moving average, which is sitting down around $187, $188.
Yeah.
And it's substantially above the longer-term 200-day moving average, which is further down, between $161 and $175.
So strong buying pressure has been pushing it up.
Yeah, it suggests that big institutions have been consistently buying on any dips, driving the price steadily higher.
And are many people betting against it? What's the short interest?
It's low. The bearish gauge short interest is only about 2.43% of the available shares, the float.
Okay.
So not many sophisticated investors are willing to bet heavily against Howmet right now. That low short interest kind of confirms the positive fundamental view.
Okay, let's look at who actually owns the stock.
Yeah.
Chapter 5, Ownership Structure. This seems to be dominated by big players.
Very much so. Institutional confidence is incredibly high. Institutions own about 93% of the company.
93%.
Yeah, that's a massive vote of confidence. It tells you that the big, sophisticated investors, pension funds, mutual funds, endowments, see Howmet as a core, almost essential holding in their portfolios.
Who are the biggest holders?
The usual suspects, really.
Ah.
Vanguard holds around 12%. BlackRock has nearly 8.9%.
Okay.
Yeah.
But does that level of institutional ownership create any potential issues, like ownership concentration?
It does introduce a potential risk. The top 25 institutional holders own over 65% of the entire company.
Wow, that's concentrated.
It is. And while it shows strong conviction from those top holders, it's also a double-edged sword.
Oh, so?
It means if sentiment shifts among just a few of those major funds, maybe they decide to rebalance their portfolios, or a big hedge fund changes its view, well, their selling can have an outsized impact on the stock price. It can lead to more volatility than you might see otherwise.
Makes sense. What about insiders, executives, directors? What's the insider activity telling us?
It's a bit more nuanced. If you look over the last 12 months, there's been net selling by insiders. About 960,000 shares sold versus roughly 491,000 acquired.
Net selling. Is that a red flag?
Not necessarily a huge one. You always have to be careful interpreting insider selling. People sell for lots of reasons: diversification, tax planning, maybe exercising stock options that are expiring.
Right, personal financial planning.
Exactly. But what's maybe more telling is the lack of significant buying on the open market by insiders at these current elevated price levels. Ah.
Okay. The people who know the company best, the executives, they seem happy to hold the large stakes they already have, but they aren't rushing out to buy more shares at 206. It suggests they might not see the stock as deeply undervalued right now. All right, no analysis is complete without looking hard at the potential downsides. Let's move to Chapter 6. Risk assessment, using that SWOT framework: strengths, weaknesses, opportunities, threats. Let's start with the clear internal strengths.
Yeah, these are pretty clear by now. The technological moat, right? Based on their IP, those proprietary superalloys, their dominant market leadership, especially in engine components, where they're often the only supplier, the sole source.
Right.
And just exceptional financial health, low debt, high and expanding margins, strong free cash flow.
Okay, strengths are clear. What about internal limitations, the weaknesses? You mentioned customer concentration earlier.
That's definitely a key one. Just two customers, RTX and GE Aerospace, account for about 21% of Howmet's total sales.
That's significant reliance.
It is. If either of those relationships were to change unexpectedly, or if one of them hit a major production snag, it would have a noticeable impact on Howmet's results.
Okay. What else?
Well, there's still that ongoing cyclical drag from the commercial transportation segment, the truck wheels. It holds back the overall growth numbers a bit. And the business is just inherently capital intensive. They have to keep spending large amounts, like the $387 million in CapEx in 2023, just to maintain their technology lead and the capacity the OEMs demand. That's a constant need.
Got it. Now, looking externally, what about future opportunities?
There are some exciting ones. The whole new space economy is a big one. Projections see it hitting maybe $1 trillion by 2040.
Wow.
And Howmet's expertise in lightweight, high-performance materials is a perfect fit for things like next-generation rocket engines and spacecraft components.
Okay, that makes sense. You also mentioned something newer: industrial gas turbines.
Yeah, this one is really interesting and potentially quite large. Industrial gas turbines, IGT, there's surging demand for these, driven by the massive electricity needs of AI data centers.
Ah, the power demands of AI.
Exactly. Building and running these huge AI models takes enormous amounts of power, and gas turbines are a key part of generating that electricity reliably.
And Howmet makes parts for those too.
Yes. Critically, the IGT market needs the exact same kind of high-temperature, high-performance turbine blades that Howmet already makes in its engine products segment.
So it's a direct fit with their core competency.
Perfect fit. If this demand for AI-driven power generation becomes a long-term secular trend, it could provide a really significant growth engine for Howmet outside of just aerospace.
Interesting. Additive manufacturing, 3D printing, is that an opportunity too?
It is. Using additive manufacturing could help them create even more complex parts, potentially faster, reducing lead times. It's another area they're likely exploring.
Okay, lots of potential upside. But now for the external challenges, the threats, beyond general economic worries like inflation or high interest rates.
Yeah, those are always there. Inflation raises their costs for materials like titanium and aluminum, energy costs too. High interest rates could make it harder for airlines to finance new planes, potentially slowing orders eventually.
But there's a more specific, acute risk looming, isn't there? Geopolitical risk.
Yes, this is probably the biggest near-term threat, especially considering that high valuation. We're talking about the proposed 2025 U.S. tariffs.
Okay, what's the specific issue here?
These proposed tariffs are aimed directly at civil aircraft components, and they would remove some long-standing exemptions that have been in place.
And why is that such a direct hit to Howmet, even with their pricing power?
It comes down to their supply chain. It's global and complex. Howmet sources specialized alloys and materials from different places around the world before they process them in their own facilities.
Okay.
These tariffs would mean immediate, potentially significant increases in their input costs for those materials.
Can't they just pass those costs on?
Management says yes, contractually they can pass them through to the OEMs like Boeing and Airbus. But there's almost always a time lag.
A delay.
Exactly. It might take 1 quarter, maybe 2, before the new higher prices they charge the OEMs actually kick in. And during that lag period,
Their margins get squeezed.
precisely,
Huh?
those fantastic margins we were just praising, they could temporarily reverse course, putting pressure on profits in the short term.
And is there a longer-term risk from these tariffs, too?
Potentially, yes. Some estimates suggest these tariffs could increase the final cost of a brand new airplane by over 10%.
Wow, that's a big jump.
It is. And a price hike that large could genuinely dampen demand. It might cause airlines to delay their fleet renewals, which would directly hit Howmet's order book and could potentially shorten this whole aerospace supercycle. It's a major uncertainty they don't control.
Okay, let's pull all these threads together. Chapter 7. Conclusion, time to synthesize. The bull case for Howmet seems pretty compelling based on its core strengths.
Yeah, the bull case rests on that really strong, defensible moat. The tech, the IP, the switching costs, they're perfectly positioned for this long aerospace upcycle.
Uh-huh.
The financials are just stellar, those expanding margins near 30% EBITDA, converting 90% of income to free cash flow. And you've got disciplined, aligned management returning tons of cash. It's a quality story.
But the bear case is sharp and focused, mainly on the price tag and external risks.
Exactly. The bear argument starts and ends with that valuation PE of 5860x, a huge premium. You have risks like customer concentration, the drag from trucking.
Right.
But the biggest near-term threats are macroeconomic and especially geopolitical specifically. Those proposed 2025 tariffs and the disruption they could cause to costs, margins, and potentially even long-term demand.
We ran an educational discounted cash flow model at DCF to try and estimate intrinsic value based on future cash flows. What did our valuation summary suggest?
Based on what we felt were reasonable, maybe slightly conservative assumptions like 9% to 11% free cash flow growth, and a discount rate between 8.5% and 9.5%, our model put the intrinsic value somewhere in the range of $180 to $215 per share.
Okay, $180 to $215. And the stock is currently trading around $205.95.
Right. So the concluding outlook is pretty nuanced. The current price is right there at the upper end of our estimated fair value range.
So great company.
Unquestionably. Howmet is a high-quality, well-managed business executing at a very high level, no doubt. However, for a traditional value investor, someone looking for a significant discount to intrinsic value, a margin of safety, well, the stock at this specific price probably offers very little of that margin right now.
So the investment decision really comes down to confidence.
I think so. It hinges on your confidence as an investor that Howmet can not only meet the already high expectations baked into the price, but also successfully navigate these significant external tariff risks without a major stumble. It requires near-perfect execution going forward.
Which leads us to our final provocative thought for you, the listener, to consider.
Yeah, think about that industrial gas turbine opportunity we discussed, the one driven by AI and data center power needs.
Right.
What if that demand for high-performance turbine parts grows much faster or becomes much larger than anyone currently anticipates? Could that provide a powerful new non-aerospace growth engine?
A new catalyst.
Exactly. Could it fundamentally change Howmet's long-term growth story in the next decade, potentially justifying even this premium valuation? It's something to really think about.
A very interesting long-term angle to ponder indeed. Howmet Aerospace. Well, that brings us to the end of this deep dive on Howmet Aerospace. We hope you found this breakdown valuable. If you did, please do take a second to like and subscribe to the Stock Analytics AI YouTube channel.
And don't forget that $4.99 a month gives you access to the entire library, 500 deep dives on S&P 500 companies. Plus, we're tackling the NASDAQ 100 next, exclusively for members.
And remember, members can request stocks too. Just drop the ticker in the comments. Before we go, the necessary disclaimer.
Yes. This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.
Absolutely critical to remember. Thanks so much for tuning in. We'll be back soon with our next deep dive. See you then.